The hang-up in Washington's debt ceiling negotiations is turning out to be longer than expected. President Biden and House Speaker Kevin McCarthy spoke on Wednesday to continue talks about America's outstanding debt limit. And while there's no deal yet, investors are wondering how to safeguard their finances if the U.S. defaults on its debt. Let's bring in Lawrence Sprung, Mitlin financial founder and wealth advisor, to discuss this. Thank you for joining us. So I first want to ask, in terms of the questions that you're getting from people, what are they most concerned about when they're looking at this debt ceiling standoff continuing?
Yeah, I mean, I think what they're looking at is how is this going to affect me, right? Because financial planning is very personal and people want to know how is this potentially going to affect me? And we have to, we really don't have any kind of precedence here in terms of an actual default outside of 1979, which was a clerical error. The only closest indication we have is what happened in 2011 prior to us coming to a deal and actually getting downgraded, which, obviously caused some significant declines even without a default.
And so then in the short term, as we're sort of still in this holding pattern of volatility here versus really taking the long-term view, assuming that the US does at some point get this settled here, how should people play this?
I think the important thing is if you have a plan in place, follow the plan, because this is going to end up being a short-term event in a long-term situation, right? And two, if you don't have a plan in place, I think that this should encourage you to make sure that you get one and have one, because this may or may not be the last time we see these types of negotiations happen with regard to debt ceiling or even other financial, economic, or market events.
And so what did we learn from 2011 in terms of perhaps some of the safe havens that people tend to go to and which ones they should actually be heading towards?
So I think one of the things we saw was the market had a sell-off, I think, in the S&P about 19%. So there was a significant sell-off. That's the bad news. The good news is it recovered rather quickly. So if you're concerned in the short term, there might be opportunities to flood to some safe havens like treasuries or money markets in order to secure some of that debt, in order to secure some of those declines. But at the same time, if you have a longer term time horizon, chances are there may be a short-term impact, but for those who are longer term, it may also provide a long-term opportunity to enter the market if this were to happen.
And so for people who did want to enter the market right now, what sort of caution or advice would you give them about how to approach when they're trying to pick, do I look at perhaps ETFs or do I look at, something more broad-based and diversified?
Yeah, I think right now, if you are looking to enter for the first time or you have some money on the sidelines, I would probably take a wait and hold approach in terms of waiting to see how the negotiations go. If we end up in a situation where there is a default, which I still think is very highly unlikely, but if we did and there was a market sell-off, that could present an opportunity. I would wait to see how this plays out because it's only we're going to probably see a resolution in the next week or so. We'll see if we have a deal in place or if there's a potential for default. So I think that would be a wait and see approach for those looking to enter today would probably be the best and wisest approach.
And based on what we saw in 2011, then, in terms of how long the volatility lasted or the most affected sectors at first, what should people keep in mind?
I think, again, we want to take a long-term approach. If you are an investor, if you're a trader, you might have a much different approach to this whole situation. And you may be taking advantage of what's going on today and not be willing to wait. But if you have a more long-term approach, then having that diversified portfolio, we always work with folks in designing the most diversified and least expensive way of entering the market and investing their portfolios. So I would do the same way. If you have the opportunity to invest due to a market decline, take that opportunity, diversify, and build yourself a long-term, inexpensive portfolio.
And for people who are sort of close to retirement, looking at this volatility and really not sort of wondering what to make of it, how would you advise them versus someone who's sort of just beginning or in the middle of their work life?
Obviously, that's a much different scenario. I would argue they have to take a deep breath and they have to look at what monies they may need in the short term versus the long term. Those funds that are more long term in nature, it will be probably a similar effect to their portfolio in the long term as it was or would be for a younger investor. For funds that they may need in the short term, next 6 to 12 months, they should be identifying or maybe getting more liquid than normal in order to have those funds available so that they're not subject to the gyrations of the market due to the debt ceiling negotiations.
I do appreciate you joining me this morning. Lawrence Sprung there, Mitlin Financial founder. Thank you so much.